Understanding options, definition, importance in real world applications. So, what is an option? Technically, an option is a contract that gives the buyer the right, but not the obligation, to buy or sell the underlying asset at a specified strike price by a specified date. So, what does that mean and how do we use it? Well, we're controlling options contracts for a short period of time to capitalize on the leveraged product. We have to choose varying option strategies and expiration dates that fit into our technical analysis mold. This starts with an understanding of how options work. In a nutshell, options are the best method to apply leverage to participate in the stock market and offer the flexibility to work in any market condition, not just directional moves. Proper options trading can be a method to grow your trading account, hedge your stock account, or generate cash flow by selling premium. These strategies offer limited risk while also offering great upside potential. Why? This goes back to how they differ from stocks and how they work. Options are a leverage tool. The cost of trading options is much lower than the cost of trading the underlying security itself. Options are highly leveraged products. Leverage, in terms of investing, means using your money to use small amounts of capital to control larger amounts of money to ideally lock in large gains. Now, obviously, you know, you can lock in large losses, which is why it's very important that you get the proper options trading education so you know how to mitigate your risk. So, let's talk about how options change in price. Even though options contracts give you the right to buy or sell securities, we usually just use them as trading vehicles. Options contracts go up or down in price depending on multiple factors, including the price of the underlying security, the time until expiration, which is also known as the time decay or theta decay, the volatility, interest rates, supply and demand, and earnings season and earnings reports. It's very important for options traders to understand these factors so they can understand how and why they're making or losing money. Movement in the underlying asset is particularly important because options are going to move in relation to the underlying asset. The movement caused based on the movement of the underlying security is where we begin. For example, if we intend to trade Microsoft, we start by focusing on the technical chart pattern, the fundamentals, and the options possibilities. Then we move into our options strategy. There's a variety of underlying securities in which you can trade options on. For example, equities, as I just mentioned, on stocks like Microsoft, Apple, or Tesla. These stocks are especially highly liquid, very frequently traded in the options market, and they're favorites of myself and many different members of our team. You can also trade index options on a basket based on stock indexes. For example, the S&P 500, you can trade the SPX, or you can trade the NASDAQ 100, which is the NDX. Now, these are, great products to trade and they're very popular with our team, especially because they have daily expiration series. So you will see our team trading these very frequently in our trading rooms because we're able to come in and trade these products and they will expire the same day. And that provides a lot of intraday and daily opportunity. Now, these are much more expensive products than ETFs. So, personally, instead of trading the SPX, I prefer to trade the S&P 500 ETF, which is going to be the SPY. You can also trade the NASDAQ, which is going to be called the Invesco QQQ Trust, which is otherwise known as the QQQs. And this is another way that you can get into the market and trade a basket of stocks instead of trading an individual stock that, is likely to be a little bit more volatile. It is also possible to trade options on futures. You can trade and speculate on crude oil, bonds, gold. You can also trade options on currencies, like the Euro USD pair. You can also trade on interest rates and commodities as well. Now, for the most part, in our options trading room, you're primarily going to see our traders sticking with these three right here, which is going to be options on equities, index options, and options on ETFs. So, why do we trade options on stocks? Well, options traders are pulled to companies like Tesla to trade. But beware, these high beta names are the most volatile and tricky for new traders to learn on. What does high beta mean? It means that it has an outsized move in relation to the move of the individual security. Now, John himself loves to trade high beta names like Tesla because of the volatility they provide. If you're coming to us and, the idea of coming in and trading options in Tesla just seems a little bit too much for your liking, let me tell you, when I first started trading options, I would never would have traded options on Tesla or Alphabet or Amazon either. I actually would stick with the low beta names. So Visa was a favorite of mine for many years because, as you can see with this trend, it had this nice, easy trend. Not too crazy. Yes, it has been more volatile in recent years, but it was a stock that just simply didn't move as much. I also traded a lot of MasterCard. I traded a lot of consumer staples like Walmart and Disney when I was learning how to trade. So, if you find yourself in a place where, you know, the uh, the underlying security that you see traders trading is going to be a little bit too wild for you, just keep in mind that you can absolutely trade options on stocks that are lower beta and they're not going to move as much, and it's going to be a lot easier for you to learn the strategies at hand. Additionally, you can also just trade options on ETFs. I personally like the sector spider ETFs. When you're trading this space in the market, what you're doing is you're just trading a basket. So you can come in and you can say, hey, you know what? I would like to trade the communication services basket. Perhaps you can see that some of our traders are trading Netflix and Google and Meta. Well, those are going to be pretty volatile, but you could also just trade XLC. The same goes for trading the technology ETF. This is going to be generally less volatile than the individual names. So you can trade options on those ETFs as well. Now, as I mentioned earlier, you will see a lot of SPX trades, especially intraday, but keep in mind instead of trading the SPX or the NDX, you can also just trade the options on the index ETFs, which is going to be the QQQs and the SPY. So, which underlying securities do you choose? Your interest, personality, availability, mentors, and risk tolerance will help make part of that decision. Testing them out is really the only way to find out which you enjoy. You may also find that you like different options throughout varying market conditions and seasons in your life. At the end of the day, just focus on your goals. What are your goals? What is your personality like? What are you drawn to? What you really want to do is just focus on the end game, right? So when you are buying options, you are purchasing an options contract or a multi leg position with the idea that the price will increase and you can sell it back for more than you paid. The difference is your profit. Your goal when selling options is to sell an options contract or a multi leg position with the idea that the price will decrease and you can buy it back for less than what you originally sold it for. The difference is your profit. So, to conclude this section, options are leverage products that trade on a variety of securities. Options have a lower barrier to entry to trade in the stock market and experience outsized moves due to their leverage. Learning how to utilize that leverage to your advantage is where the sweet spot is. Thank you so much for joining me for this session. I'm looking forward to jumping into the next topic with you, which is going to be various use cases, hedging, speculation, and income generation. I look forward to seeing you in the next episode.